Welcome to the Killik Explains finance video. This week, a topical term that's doing the rounds in financial markets, unicorns. And I'm going to suggest that equity investors should be wary of them, particularly if they're new equity investors. Why? Well, first of all, what's the background? So what do we got here? Unicorns are private companies with valuations of $1 billion or more. That's the loose definition. And there are an awful lot of them out there. Why? Thanks to the world of off-piste, as I call it, private equity, venture capital, sovereign wealth fund finance. In other words, there are places where companies can now grow fast and big away from public markets. And that's the unicorn space, if you like. A flood of them are now coming to public markets for different reasons. One of them being if they want to raise a really serious amount of capital for further growth and expansion, public markets are one way to do it. So you've got a flood of household names, I'll mention a few in a moment, coming to the market looking to raise capital. So going from the private space into the public space, if you like. The question is, are there an investment opportunity for private investors? Now, in some senses, you'll have no choice. These things are monsters. They're big companies. So indexes and index funds will pick them up naturally and you'll get an exposure through your pension, for example, whether you like it or not. That's not my question, because you haven't got much choice about that. My question is, should you be looking at these things as shares to pick off and add to a portfolio? And I think you want to be a little bit careful here. Now, examples. So you're thinking, who are the unicorns? We will recognise them straight away, I think. Most people have heard of these names. Lyft and Uber, ride-sharing taxi apps. So both of them in the space where basically if you want to get a cab, you can book it through an app. You don't have to go to a black cab in London, for example. So there's controversy there because obviously they're undercutting traditional taxi markets. But most people get the idea. And Lyft is the big sort of US competitor to Uber, if you like. Airbnb, most people have come across that one. If you're looking to book a room, you no longer have to go to, for argument's sake, a Hilton hotel. You can go onto the website, in the app, and look around people who've got a room in their home spare or even an entire home spare and book it through the Airbnb app, and they take a cut for arranging that. So that's a kind of letting hotel app, if you like, hotel competition app. And then you've got Pinterest. If you're looking around at people's interests, they can sort of pin them on a board, a digital board, share that information, give other people inspiration. So it's a community-based app product, that one. And there are more. You might have come across Zoom is a big name at the moment going to the public markets. So there are lots of these unicorns around and there's a kind of flood of them. The reason they're getting the media attention is quite a few of them coming almost at the same time to public markets. And there are more besides those big names. Those are the ones you've probably heard of. And that's problem number one. So a brief summary in a moment of the 4 or 5 problems is going to include the fact you've probably heard of them. Now, all of these have been grown in private hands. Most of them have had some sort of private equity, venture capital backing. So these are experts, if you like, who are able to bring capital to firms without going through the mechanism of a public market like the London Stock Exchange or the New York Stock Exchange. And they're all coming to public markets via something called an IPO, initial public offering. So what's the problem? You might think he's a real killjoy. These are great names. I've got the apps on my phone. I use them every day. Why is he saying be careful as an investor? And that's the point. 4 or 5 problems coming up. And one of them is just because you've heard of something and just because you use it doesn't necessarily make it a good investment. It can sometimes, but in these cases, be careful. They're popular. Now, Warren Buffett's always said you want to be greedy when others are fearful. Well, no one's fearful here. Loads of people know about Lyft, loads of people know about Uber, loads of people use Airbnb these days. So everyone's heard of these names. Their services are fairly simple, are well understood. I need a room for the night, Airbnb, let's see what's available, bang, off you go. Connect your credit card, job done. They're pretty simple to understand, and those are reasons not necessarily to jump in and buy them as individual investments. That's the point. You're not necessarily going to get a bargain. You are buying something that's already popular, that's got some, if you like, some hot momentum behind it, and that's not always a good idea. But it's not just that that's the problem here. Number 2, most of them lose money and do it impressively. So, not in all cases. So Zoom makes a bit of money if you've come across them. Pinterest is close-ish to making some money from that sort of digital pinboard idea that I talked about just now. But Lyft and Uber are way off. They're losing around $1 billion a year, depending on which year you look at, so last year. So they're losing colossal amounts of money. And this makes them both a bit of a tough ask from an investment point of view and also tough to value. Now that doesn't stop analysts having a go. Clearly someone's got to put a price on these things and a price target and so on. So problem number 3 is the hard price to go. What I hear quite a bit of is people say, well, hang on a minute, any one of these could be the next Amazon. And what they're saying there is, if you'd invested in Amazon, you had faith in Bezos many, many years ago, you'd have been rewarded handsomely. In fact, you'd probably be retired by now. You wouldn't be watching this video, if you like. But the problem is, none of these are the next Amazon, almost by definition. It's not that they're not good companies in the sense of having good ideas and growing them fast and so on, but expectations are already high. So if you're looking for a bargain, you're probably not going to get one. On a price to sales basis, if you're thinking, why sales? Why not earnings? Well, don't forget a lot of these companies have no earnings or positive cash flow. So you've got to go for price to sales, which is a bit of a floaty measure for a start. You're looking at 10 or 11 times for a Lyft and a Pinterest. That's pretty punchy valuations. So you are paying for what you get, or what you don't get, a cynic would say. And therefore Amazon 2 is probably not on offer. I know it sounds disappointing. You're thinking one of these unicorns must be the 20, 30, 40 bagger that I'm after. That's going to see me early retired in Barbados, if you like, but no, not necessarily. Amazon was wasn't well known when it started out, if you like. People didn't realise that it was actually a logistics company more than it was a web expert, if you like. That's where its USP was. It added a lot of value after it listed, not before it listed, and so on. So there are quite a few reasons why you shouldn't look at these and necessarily conclude that one of them has to be the next one. Insiders are selling. That's an obvious point to make, I suppose, but basically private equity and VC backers are getting out at this point. Now, these are shrewd investors. They tend to time their exit fairly carefully. Yes, I get that in public markets you can raise more capital than is potentially available in private markets, but you can raise a heck of a lot of money in private markets. So much of the early land grab has probably been done, and these people are now getting out and asking you to come in. And, do you want to buy right at the point where intelligent, experienced investors seem to be selling, and selling in quite large numbers? And finally, the mechanism you're being asked to buy through, the IPO, can be a tricky one. It's not to say you shouldn't do it ever. Clearly not. IPOs happen all the time, but be careful. As a novice investor, this mechanism has been shown by Jay Ritter of Florida University to be tricky. So 60% of 7,000 IPOs between 1975 and 2011, that's a pretty big sample, had negative absolute returns after 5 years. 80% of new issues in 2018 were loss-making. Okay, Lyft and Uber added to that list, if you like, versus 25% in 1980. So it's got more and more difficult, potentially, to pick the rising stars from amongst the IPO crop. Now, it can be done. People make money from IPOs, but it does help if you've got direct participation. All right, if you can get into the primary market stage, if you like, it gets a lot tougher if you're jumping in, as most retail investors would be normally, at the kind of secondary market phase after the pop, as they call it, on the first day of trading. So there you have it. 4 or 5 reasons why unicorns, I think, are fairly tricky investments. You've got no choice about whether you invest in them indirectly, index funds, pension funds and so on, but you do have a choice about whether you go directly for the shares themselves on a one-for-one basis. I think you need to be careful. Editor at Killik.com with queries, and if you want to watch videos that talk about things like price to sales ratios, which I skimmed over in more detail, Killik.com/learn, and down here I go for the shares